So today we're diving into a really aggressive analysis report arguing the market is caught in a bear trap with AMC stock.
Yeah, the core idea is that everyone's ignoring successful debt refinancing and this projected mega cash flow quarter coming up.
Exactly. A quarter supposedly driven by a huge Q4 2025 movie slate. So the heart of this whole aggressive buy thesis seems to be that immediate catalyst.
It has to be. That timing is, critical if you want to refute the whole imminent bankruptcy argument that's been floating around.
Right. But when you actually look at the mechanics, the analysis relies so heavily on the holy trinity of box office releases, and that creates an inherent, unexamined single-point dependency risk. I think I see where you're going. So the weakness is that the entire calculation for positive free cash flow in Q4 2025 is pegged directly to the performance of Avatar, Fire and Ash.
Pegged is the right word. Yeah. It specifically needs 80% of Avatar 2's performance. We're talking about, $1.84 billion globally? That's the number they say guarantees the cash flow target.
And that's a huge number.
It's a massive number, and the report is just so highly leveraged on this one optimistic outcome. The real weakness is that there is zero discussion of the financial ramifications if this nuke, as they call it, underperforms that benchmark.
So it's all upside.
It's all upside. And by doing that, the report creates this easily exploitable gap for any skeptic who wants to challenge the rating. The whole thesis could just collapse under a little bit of pressure.
Okay, but if you have high conviction, you want to project that, right? How do you introduce stress testing without, watering down the optimism? Doesn't modeling for failure just give the bears new ammunition?
Not if you frame it correctly, no. The report can actually strengthen its own case by integrating a structured sensitivity analysis, or even just some clear scenario testing around that Q4 catalyst.
Okay.
The goal isn't to say, hey, our thesis might fail. It's to show that even if the main catalyst is a bit weaker than we hope, the bankruptcy risk is still off the table, that the underlying value is still there. It shows discipline.
That makes sense. It reframes the whole conversation. It's not if the movie succeeds anymore. It's how low can the movie go before that debt crisis comes back.
Exactly. And let's get concrete about how to do that. We'd recommend modeling a specific downside scenario. For instance, what happens if the nuke release only generates, say, $1.5 billion globally?
Still a huge hit, but well below their required baseline.
A very strong performance, yeah, but a big drop from the $1.84 billion they need. The analysis then has to show the precise impact on Q4 free cash flow and, more importantly, the knock-on effect for the 2026 adjusted EBITDA projection.
Which is that $571 million figure.
Right. Showing that the 12% EBITDA margin holds up even if the main catalyst is under pressure, well, that would be incredibly powerful.
And it would directly counter that low stock price argument, the one that's based on imminent bankruptcy.
You have to address it head-on with this stress test. If your core thesis is neutralizing bankruptcy risk, then you need to demonstrate precisely at what global box office number that risk becomes active again. That gives a hard, data-driven floor to the whole investment idea.
It forces the reader to see that the current price is discounting a much, much worse outcome than the model even suggests is likely.
And it adds real, immediate usability for the investor. They now have a clear metric they can watch, that box office number, to gauge the safety of their investment.
Okay, so that adds a necessary layer of depth. Let's move on from the Q4 catalyst then and turn to the other big pillar here, the overall financial health. This really gets to that question of, is the company cash flow positive soon? The report makes a strong start. It highlights that the 2026 debt wall has been successfully pushed out to 2029-2030, calling it an undisputed fact.
And that's the right place to begin. Absolutely, because it dismisses the immediate maturity risk. But to fully neutralize that main bankruptcy thesis, the analysis needs to do more. It has to bolster the presentation of those debt exchanges with specific transactional details.
Hold on a second, though. If the goal is high-level impact and the immediate threat is gone, isn't getting into interest rate differentials a little too deep in the weeds?
I see why you'd ask that.
I mean, why is the cost or the quality of the new debt so relevant if the maturity risk is gone?
It's relevant because the bear argument isn't just about maturity. It's about the company's long-term inability to generate sustained profit. Think about it. If the company used really high-cost debt to buy itself some breathing room, then that room is, it's an illusion.
Because the new debt payments just drain future cash flow.
Exactly. It completely undermines the path to that $571 million EBITDA target in 2026. So the weakness here is that the analysis provides zero support to quantify the cost or quality of this new debt.
So the lack of detail just leaves this loophole. Skeptics can just argue the breathing room was bought at an unsustainable rate, or it came with these really restrictive covenants.
And you can't let them do that. The report has to provide enough depth on those exchanges to make the breathing room conclusion logically sound and, sustainable. It's about showing the quality of the move, not just that the move happened.
Okay, so what specific, high-level details can be added without turning this thing into a dense legal filing? We need something surgically precise.
Focus on the interest rate structure. That's key. The report should include some top-line details from the mid-2025 debt exchange. Specifically, are the rates on the new 2029-2030 debt materially higher or lower than the old 2026 debt?
And if they manage to refinance at equal or better rates, that's a huge win.
It's a profound point of strength you have to hammer home. And if the rates are higher, the analysis needs to briefly explain why that extra cost is acceptable given the operational improvements they're forecasting for 2026.
That's a crucial piece of data. It directly answers the whole cost of survival argument.
And we should also touch on operational freedom. If possible, a brief mention of any new restrictive covenants that might impact the company's ability to operate.
So things like limitations on capital expenditure?
For example, yeah, or restrictions on how they can use free cash flow outside of just paying down debt.
But why is understanding covenants so important for the general reader of a report like this? How does that tie back to the main aggressive buy thesis?
Because if the covenants are too strict, say they restrict investment in cinema upgrades or new popcorn flavors or whatever, it directly hampers future growth. It doesn't matter how well the box office does.
Ah, okay.
Showing you're aware of these details proves you have a comprehensive view of the debt profile. It confirms not only that the company secured its survival, but that it also kept the flexibility it needs to expand and actually hit that $571 million EBITDA target.
Which brings us perfectly to the long-term outlook. We've talked about stress testing the catalyst and beefing up the debt details. Now we have to talk about the elephant in the room. That projected $571 million adjusted EBITDA for 2026.
That figure is everything. It suggests a margin expansion from, 7% to 12%? That is the single most powerful fundamental data point in the entire analysis. It shifts the conversation from just survival to actual intrinsic value.
I agree, but the report needs to structurally integrate that projection much more prominently. It should be the primary anchor for the whole valuation.
Exactly. The weakness right now is one of flow and emphasis. That powerful number is kind of buried. It's in the financial forecast section and then gets a brief mention in the verdict.
Yeah, the final verdict emphasizes the Q4 box office trigger, which makes it feel a bit transactional. It's not emphasizing the fundamental long-term value being created.
So we have to resequence the argument. Place the 2026 EBITDA forecast as the central justification for the aggressive buy rating. Then you can frame the Q4 box office success as merely the catalyst that forces the market to finally recognize that already established sustainable value.
That's a fundamental shift in the message. It goes from the company avoids bankruptcy to the market is fundamentally mispricing future earnings.
Yes.
It gives the aggressive rating a much firmer foundation, Something anchored in future profitability, not just a one-time cash injection.
Precisely. Because if the analysis can effectively show that the company is on a clear path to $571 million in EBITDA, then the current price, which implies this dangerously low multiple of about 7x EBITDA, well, it just becomes indefensible.
So how do we make that structural change obvious in the report? Where does this number need to show up besides a table in the appendix?
You start right at the top. In the executive summary, the report should explicitly link the bear trap not just to the debt and the movies, but specifically to the market's failure to incorporate the projected 2026 financial efficiency, that $571 million figure, into its current valuation.
Make the failure to value future cash flow the core of the thesis.
It has to be. And then we have to make sure that the price target, the $2.50 to $3 range, is explicitly tied to that efficiency metric, not just to neutralizing risk.
Right.
Absolutely. When discussing the price target, you state clearly that the repricing is justified by a fundamental move toward a standard industry multiple. You clarify that a shift from the current depressed 7x multiple to a more justified 10 or 11x, which is common for stable operators, is exactly what drives that price target.
So by making the value proposition quantifiable and transparent, linking it directly to that 2026 number, the report maximizes the power of its own forecast. It forces the reader to really confront the huge gap between the current stock price and the company's projected financial reality.
And the entire argument becomes so much more robust. The Q4 box office is now just the ignition switch for the car, but the 2026 EBITDA is the engine that determines